Hi everybody, this afternoon on the marketplace, inflation for the month of July declined sharply to 20.9% as Citi shows signs of stability.
In the month of July 2024, the rate of inflation stood at 20.9%, indicating that general average prices of goods and services in Ghana went up by 20.9% between July 2023 and July 2024.
Also coming up, MTN close to reaching national roaming agreement with Telecom after a similar deal with mobile operator AT. Plus, Ghana is 6th leading gold producer in the world according to World Gold Council, coming after USA and China as China tops the global rankings. My name is Darryl Kwao. Thanks for joining us, everyone. Details coming up. Thanks for staying with us, everyone. We begin with some inflation news. Inflation for the month of July has declined sharply to 20.9%. This represents a decline of 1.9 percentage points from that of the month of June, which was at 22.8%. According to the Ghana Statistical Service, food inflation decreased to 21.5%, whilst non-food inflation also decreased to 20.5%. Government statistician Professor Samuel Kobnenim, addressing the press, indicated that the inflation on imported items declined to 15.6% from 17.5%. This he attributes to the stability of the city in the month of July.
In the month of July 2024, the rate of inflation stood at 20.9%, indicating that general average prices of goods and services in Ghana went up by 20.9% between July 2023 and July 2024. While this rate of inflation indicates a 1.9 percentage point lower than the rate that was recorded in June 2024 of 22.8%, it signifies that it's only the rate of change that has slowed down over the same period last year and the same period this year. Prices of goods and services continue to increase both on a year-on-year basis and on a month-on-month basis. On a year-on-year basis, general prices of goods and services went up by 20.9%, and on a month-on-month basis, general prices of goods and services went up by 2.1%. From a disaggregated point of view, we continue to see the dominance of food inflation, leading with a rate of inflation of 21.5% relative to non-food inflation 20.5%. From a locally produced item and an imported item perspective, we see the dominance of locally produced items with a 7.7 percentage point drop, with locally produced items recording a rate of inflation of 23.3% relative to 15.6% for inflation on imported items. We focus on average price levels in the month of July 2024. In the month of July 2024, on a year-on-year basis and on a month-on-month basis, we identified at the item level prices that recorded the highest upward changes over the year-on-year, that is July 2023 and July 2024, and on a month-on-month basis between June 2024 and July 2024. On a year-on-year basis, the two top items that recorded the highest price changes were garden eggs and dried pepper that respectively recorded upward price changes of 57% and 54% on a year-on-year basis. On a month-on-month basis, we continue to see items with significant weight, specifically tomatoes and yam, with significant weight in excess of 1, specifically 1.2 and 1.6, finding its way in the top 20 items with highest upward price changes, changing by respectively 57.7% and 45.0% for the month of July 2024.
The government statistician there, Professor Samuel Kobnenim, addressing the press a while ago, inflation dropping to 20.9% in July. Now, finance and accounting firm Deloitte Ghana is raising concerns that the country's debt in relation to the size of the economy target could be disrupted after exit from the IMF program. In its analysis of the 2024 media budget review, Deloitte Ghana advised the government to channel borrowed funds into self-financing capital projects. Earlier, I spoke with Senior Manager, Financial Advisory at Deloitte Ghana, Dennis Brown. I started by asking him Deloitte's assessment of our economy right now.
Currently, I'll say that our economy is on a recovery process after being battered severely by debt sustainability issues over the last 2 to 3 years. Finally, we are seeing some recovery per the information that was shared by the Minister of Finance in Parliament. I think when you look at the budget, it's only sought to give us progress updates on the implementation of the 2024 budget and also to inform us that government is now a bit more confident about the prospect of the economy and therefore had occasioned some revisions to the key macroeconomic indicators. So all of that really speaks to the fact that we are on a certain recovery process.
But debt remains a major issue right now, and you have concerns about our debt service management or commitment after the IMF program. Tell us why.
Yeah, that is so because we've made progress with our debt restructuring. The first phase being the domestic debt restructuring, which brought us some reliefs through the haircuts, the term that became very popular. Subsequently, we've engaged our external creditors, so multilaterals, bilaterals, and our Eurobond, creditors. We've engaged them, and the effect was to see how we could get some relief from there as well. Over there, we've been successful. We've had debt relief of about 4.2 billion, which is different from debt cancellation, which is about 4.7 billion. So debt cancellation is debt forgiveness. So there's a portion of the piled up debt that you are forgiving and not required to pay. The debt relief really is deferral of your debt service commitments till, in this case, after the IMF program. So the consideration is that over the IMF program, there are a lot of measures that are being taken, austere measures, and therefore it would be good for them to grant some relief, and we managed to get them to grant that relief. What it means is that you are not paying those commitments over the period of the IMF, but after the program, which is after 2026, you would have to return to those commitments. So the debt pressure would return. What we need to be careful of is that we shouldn't go to sleep. We don't want a situation where by the end of 2026, we would have narrowed the fiscal space again, which is the fiscal consolidation thing we are doing now, trying to create more fiscal space so we can accommodate, expenses and all that. Once that happens, you are back to the same situation where there's no fiscal space and there's this introduction or reintroduction of what ought to have been paid previously, now back after the IMF program.
I want to talk next about inflation and the cedi, which are also major hurdles the government will have to surmount in this period. I mean, we've seen the cedi lose value against the dollar up to 19%, and the Christmas festivities are approaching, elections are approaching as well. Talk to us about the risks ahead and what the government should be doing.
Okay, so first of all, let's talk about inflation. I see we have a year-end period target of 15%. If we're standing...
is that feasible in itself?
Yeah, exactly. So if we're standing at the beginning of the year, I would say yes, with a set of measures that we monitor closely, we should be able to achieve that. But having looked at what we've done by mid-year compared to where we were, there's been improvement, but it's been marginal, and we're already half year. I think the inflation by end of June was around 22.8% compared to 23.2% or so by end of last year. So the improvement has been marginal. It tells you that the factors that are influencing inflation have been quite rigid. There's been measures taken, but they've not impacted those factors that much. And so whilst we've seen improvement, it's been very rigid. So the question is whether from now till end of year, we are just about 4 months till end of year, there are measures that, can be expected to impact that significantly to the extent that we are able to achieve that 15%. I doubt. I think it's a tough task. And if we are going to achieve that, then we need to be very consistent in those measures, and we need to, tighten the discipline that we've shown so far by media, as reported by government. That's the only way we will be able to achieve that 15%. But I think, it's not likely. Now let's talk about depreciation of the cedi. Yes, we've seen improvement, but that has been quite recent. I think in June we saw some notable improvement in depreciation. And that was on the back of the inflows that came, I think the third tranche or so on the IMF program, so to shore up our reserves. And therefore, that has influenced the statistic a bit. But if you look at it prior to that, the first 4 months or so, we saw consistent depreciation of the local currency. So what happened in June in terms of the inflows we took from IMF have come to provide some respite, and we've seen that reflect in the depreciation rate, especially the dollar and the cedi, right? But the risk still remains because we know what happens in December. There's a rush for the dollars because we are an import-dependent economy. There's a lot of buy and sell, and a lot of buying is coming from offshore where people would have to, go and bring goods. Then there's also the thing around whether government is still going to maintain their discipline into the election, because what you'd see is that in and around this time, there's a lot of release of money into the system by government for various projects. Those monies get into the pockets of people, and it creates what we call demand push inflation. So you have a lot of money chasing fewer goods and services, and that puts pressure on price. So those risks are there, and we are bound to see them again, particularly because of the election year and the Christmas festivities.
One other thing you took a look at was the tax approach. There are no new taxes mentioned in the media review. What do you make of government's approach to taxes? Does it solve the problem of raising more revenue and ensuring that we are covered in that space?
I think overall we can describe government's approach, to taxes this year as conservative. Because we can see that there were no introduction of new taxes as we've seen previously, and there were no increase in existing tax rates, etc., as we've also seen previously. And I think that's on the back of two things, really. If you look at the IMF program, there was a lot of focus on tax reforms rather than introduction of new taxes per IMF recommendation, that there are sectors that you could look at what exists already and make reforms to improve efficiency and effectiveness of those taxes. So that's where the focus has been. Rather than bringing new taxes, you see a lot of measures targeted at improving the efficiency at which the existing taxes are administered and therefore the effectiveness of same. Then we've also seen an outcry from the business environment of all these numerous taxes, some of them having been described as a lot of nuisance taxes ahead of even putting the 2024 budget together, the original budget, not even the revised budget. So some of those concerns would have also gone into the measures or the approach that government took to be a bit more conservative. And of course, we can't also take away the fact that we are in an election year.
Right.
You don't want to be throwing taxes at the people from whom you want the votes anyway. So there's a bit of that strategy, electioneering strategy also playing out there.
All right, so what are the recommendations you are making to the government going forward?
I think it is very clear that for the first half of the year, per the report that we've seen in the mid-year budget, government has remained disciplined. And they've shown what I would say notable levels of discipline to churn out the results that we are seeing. We've seen instances where revenue has gone up and expenditure has dropped, and they have even revised that further to take revenue up by about 0.5% of expenditure to decrease by about 3.2% by end of year. Clearly speaking to government's commitment to creating the fiscal space or achieving the fiscal consolidation that underlines the stability that we all want. But we know that a few months to election, some of these things can get off track. And so the recommendation to government is that if this time they can master the political will to maintain the discipline and damn the consequences just for the sake of Ghana, so we can transcend this period and move into periods of higher growth after the election.
Thank you so much. Dennis Brown, Senior Manager, Financial Advisory, Deloitte Ghana. We appreciate your time with us here on the Marketplace. All right, that was my conversation earlier with Dennis Brown of Deloitte Ghana. Well, another auditing and accounting firm, KPMG, is asking government to start implementing some approved tax measures announced in the 2024 budget. This follows government's inability to unlock the full impact of some tax legislations to improve collections. KPMG made the call in its 2024 mid-year budget review. Here's more in this report.
The government has in recent times passed new tax legislations which are yet to be operationalized due to unavailability of a regulation or administrative guideline to facilitate their implementation. Key among them includes amendment of the VAT Regulations 2017 to grant exemptions on active pharmaceutical input and finished products, completion of the regulation for the Exemption Act 2022, and the development and completion of guidelines for the implementation of the emissions levy an environmental excise duty. In its review of the 2024 mid-year budget, KPMG believes the implementation of these systems will propel its quest to rake in additional revenue whilst widening the tax net. Considering the time it takes for tax dispute to be settled through the courts, it also proposed the use of alternative dispute resolution (ADR) as the overwhelming go-to solution. The statement implored government to focus earnestly on the digitalization of the property tax administration, as this has the potential to affect revenue growth positively.
In other news, Ghana is now the sixth largest gold producer in the world. That's according to the World Gold Council data at the end of June this year. Here's more in this report filed by George Yafe.
Ghana got this latest rank after it produced 137 tons of gold in 2023. This represents some significant jump from what it produced in 2022. But this volume of production, Ghana came directly behind USA that produced 166.7 tons of gold for last year. In Africa, Ghana emerged the top gold producer, interestingly followed by Mali with 105 tons of gold, and then South Africa with 104 tons. China emerged as the largest producer of gold in the world in 2023, accounting for around 10% of total global production. The Minister of Lands and Natural Resources, John Jinapor, in a recent interview with Joy Business, disclosed that the surge in gold production can be linked to favorable government policies, leading to improved investment in the sector. Gold prices over the past years have also witnessed some sustained increment, and it's not clear for now how that has contributed to this performance for last year.
While still staying with the mining sector, the reclamation liability of Abosso Goldfields Limited AGL Damang Mine was estimated at $24.99 million as at December 31, 2023. The company, however, posted a security bond of $25 million, comprising $12.3 million cash and a $12.7 million bank guarantee with First National Bank. This means that in the unlikely event that the mine fails to rehabilitate the disturbed lands, the state can fall on the $25 million bond to carry out the rehabilitation of the land. Natalia Kwanzaa has more in the following report.
The operations manager of the Damang Mine, Samuel Arthur, expressed gratitude for the continued support from all stakeholders. He highlighted the importance of this forum in the company's DNA, emphasizing Goldfields' commitment to concurrent rehabilitation. The forum also showcased the mine's current reclamation efforts.
Our company's policy on reclamation is concurrent rehabilitation. We therefore rehabilitate disturbed areas alongside ongoing mining operations and do not wait until mining activities cease completely. We remain cognizant of the life of mine plan and reclamation security agreement and the socio-economic activities the land can be put to, present and after mining. AGL has, however, posted a security bond of $25 million, comprising $12.3 million cash and $12.7 million bank guarantee with First National Bank. This means that in the unlikely event that the mine fails to rehabilitate the disturbed lands, the state can fall on the $25 million bond to carry out the rehabilitation of
the manager shared that 523 hectares out of 1,455 hectares of disturbed land have already been reclaimed. Participants took tour to the rehabilitated areas, witnessing firsthand the positive impact of these activities on the local community.
All right, you're watching The Marketplace. Let's talk tech coming up next. And we're going to be heavy on the telecom sector this afternoon because mobile operator MTN has revealed that it is in the final stages of reaching a long-term national roaming deal with Telecom. This was captured in an investor update to shareholders. Details in the following report.
The national roaming agreement will ensure that subscribers of Telecom will automatically switch to MTN's infrastructure to avoid service disruption, especially in an area that Telecom has not gotten the required infrastructure to help them make and receive calls, as well as data services. The same will apply to subscribers of MTN. MTN has already finalized a similar deal with mobile operator AT, making it easier for their subscribers to have access to service irrespective of which part of the country they find themselves. The idea, which is pushed by the National Communications Authority, is to ensure that subscribers are not deprived of quality service despite their location. But according to MTN, despite competition, it remains fully committed to this program.
Right, on Zoom with us is lead for Eyes of Africa, Henry Kobler. Good afternoon to you, Henry. So how significant is this news? How does it benefit the government, the telcos, and the public as well?
Thank you very much, Daryl. So, this is a very good policy that NCA relatively is throwing out to the telecoms, and the implementation of it is really going to help us. If you really look at the telecom sector and the competitions, relatively from MTN hitting up with AT and Telecom. One of the things that I was looking out for Telecom to come in, especially with a rebrand, was one of these implementations of this policy, which gives us a credible and quality service. Generally, even if you're off the grid or within the catchment area, should be able to jump onto MTN's network and still be able to make use of the services that either Airtel or either Vodafone or Telecom would relatively give you. And so generally, it gives a very good prospect in the usage and the quality of the service, regardless of the network that one would find themselves in. And again, also to be able to make use of the services which are sitting on it. If you're looking at what MTN relatively portrays, just between the first half of the year, they're declaring almost about 40 billion in terms of the revenues that are coming in from data alone. You can understand that gives a significant portion to them. And being able to have that and being able to now share infrastructure with the other competitive telecoms relatively also gives them some level of leverage, and usually would also now bring in the cost of data prices and other services way lower.
All right, let's turn to some other news. Telecom, meantime, looking to increase voice and data charges. I'm not sure about the timing, especially when we've seen a lot of complaints in recent times when MTN was tagged as having some of the lowest prices here on the continent. What do you make of this?
Daryl, just looking at what I had mentioned earlier, MTN is really looking at almost about 55% on data. And so for them to raise the revenue of almost about 4 billion, it gives you a very high sense of how people have become very active with data. If you're looking at MTN's data, generally almost about 15.9% year-on-year active data subscribers. Same could actually be looked at for the other competitors. And so that means that the data market really has a lot to push out. And so if Telecom is looking at being able to decrease its prices to be able to attract more people onto its network, I think that makes a very good sense in terms of business competition points. But again, we're also looking at the quality to it's going to be on. And again, from the very first story, you could understand that being able to jump on other telecoms network would really enhance the usage of the data systems that will be put in place and the infrastructure that would help us to grow. And so for me, generally, policy also makes a very big deal in this. I think that the policymakers really have to sit and look at how they could grow the pointers of the active data usages of the other telecoms rather than use pricing to be the medium to decreasing the monopoly of MTN over the other networks. Decreasing data prices really is going to help us in terms of our drive for digitalization, and I think that it's a good cause. If Telecom is looking in that direction, I'm thinking that the other telecoms would also look.
Is actually looking at increasing data costs, Henry. And I just wonder how much of this borders on operational costs, because we've seen some telcos really struggle and then exit the Ghanaian market.
Yes, so I got your point earlier wrong. I mean, generally, increasing the price of the telecoms is coming in mostly in terms of the operational cost and again, to taxes and, I mean, to the levies that are placed on some of these services, not just the data services alone. And if you're looking at, I mean, I can speak to the data for MTN, even if for the cost, the high cost, you're still looking at year-on-year growth with the usage. And again, you're also looking at almost about 7.5 increase in the megabytes that people are using. So increasing the data cost on that level really gets to be a bit scary. I'm looking at these telecoms, like I mentioned earlier, I'm looking at rather Telecel and other competitive telecoms, rather looking at decreasing the cost to attract more people rather than doing an increase in the cost.
Is that even possible, looking at the state of the economy and the cost of running the operations?
Yes, I mean, generally it's possible. If you're looking at growing the market, it's based on numbers. And so if I'm decreasing the cost of my cost on providing the data for people and I'm increasing my subscriber rate at a higher point, I think that they can relatively make do for that, for the usages as well. I mean, just increasing prices does not guarantee that you're going to have a lot of people coming in. It's also depending on the usage of the data for people as well. I mean, right from my office, we've started putting and implementing data usages in the office. And so we're sort of starting to cap the usages of data within the office. And that tells you that if you increase in the data, we're also looking at decreasing the usage of our data right from the offices. And so we've implemented applications that are stopping the usages of auto updates of applications on our mobile phones and our PCs and all of that, which guards the use of data. So increasing it gets scary. We also now start putting in implementations to now safeguard our data usages, and that does not really help businesses in the telecom sector. So again, I think that there are more innovative ways to get to have the monies coming in from the data side rather than just increasing the prices.
Some great advice there. Henry Kobler, lead ISO of Africa, thank you so much for joining us here on the Marketplace. And that's our program, everyone. Thanks for watching. More news on our website, myjoyonline.com/business. We've got news on inflation dropping to 20.9% in July. You want to read more about it. Plus, 1D1F is a brilliant policy, but it should be left for the private sector. That's according to business mogul Mark Dan. myjoyonline.com/business. Thanks for watching. We will be back same time tomorrow.